Welcome back to the portfolio, everyone. And today I'm sharing with you the 2 dividend-paying stocks I am buying this week and adding into my financial freedom portfolio. So currently my portfolio sits at a value at $31,879. And of course, this is a dividend growth portfolio. I'm buying dividend-paying stocks to overall increase my passive income, to one day be able to use that passive income to pay my monthly bills and achieve financial freedom. So I am the Gen Z investor. I have a long-term dividend outlook. I am investing for the next 20 to 30 years. And if you want to look forward to watching my portfolio grow along with me, please like and subscribe. All my videos on this channel are related to the stock market investing, and personal finance. And today we're going right into the 2 dividend-paying stocks I plan to add into my portfolio this week. The first stock I plan on buying this week is BMO, Bank of Montreal. Currently trading at a value just about $70 a share. This is Canadian dollars. Of course, this is one of the big 5 banks in Canada. And if anyone who understands the Canadian economy, it's that the big 5 banks operate as an oligopoly. The big 5, they control the overall financial market, and they're very dominant. They have great balance sheets, and they're very strong dividend-paying companies. So of course, I already own 2 of the Canadian big 5 banks in my portfolio, and BMO Bank will be the third. And once again, we move down. We're just going to start with some of the financials, and I'm going to share with you exactly why I think BMO Bank is a great dividend-paying stock to add to your portfolio. So one thing I really want to point out right at the beginning, because we're going to touch upon this a bit later, is BMO Bank currently has a market cap of about $45 billion. So their shares are trading at a value which represents the overall value of the company to only be $45 billion. That's going to be somewhat significant moving forward, but I really want to point that out. $45 billion market capitalization. Very nice thing right here is that they have a 6.27 dividend yield. So a massive over 6% dividend yield. Of course, they also support a very sustainable dividend payout ratio at just around 50%. So they have a very sustainable payout ratio, and right now they're supporting a massive 6.27% dividend yield. And one thing about BMO Bank, if you didn't know, they are Canada's longest dividend-paying company. They have the longest active dividend-paying streak in all of Canada, and we're going to jump into that right now when I move over to their 2019 annual report to shareholders. Before we talk about the actual dividend information, this is why I like BMO Bank. One of the reasons I really enjoy BMO Bank, and it's my 3rd favorite bank of Canada's. So the Canada has big 5 banks, and I've decided that I'm going to hold 3 of the 5 in my portfolio: Royal Bank, RBC, TD Bank, Toronto Dominion Bank, and my 3rd and final bank I'm going to own is Bank of Montreal, BMO Bank. So if you look right here, this just shows where they have corporate offices and where they operate across North America. So you see a lot of blue, of course, throughout Canada and a bunch of different states throughout the United States. And if we move down, they also have international offices in various countries around the world. So they do have a lot of international income coming into their balance sheet, into their financial statements. And a very interesting right here is this is what I was talking about here. They have a 191-year dividend record. BMO Financial Group has the longest running dividend payout record of any company in Canada. At 191 years, BMO common shares had an annual dividend yield of 4.2% on October 31st, 2019. So on about 6 months ago, their yield was about 4.2%. Now with this dip in the market, I'm buying the same strong financial company, now has a yield of 6.2%. So I'm getting an extra 2% yield for the same company with a massive 191 dividend record. That does not mean they've increased their dividend for 191 years straight, but they have consistently paid out their dividend. They have not missed a quarterly dividend payout in 191 years. During some recessions, they have not increased every year. They've made it consistently paid out the same amount. For example, during the 2008 financial crisis, they did not increase their dividend that year, but they continued to pay out the same amount for 2 years in a row. But then they continued to increase it once that all passed, and they've continued to increase it moving forward. So the BMO Bank has a 6.4% annual growth rate on their dividend, which is very nice to see. If you've watched any of my previous videos, I mentioned that I like dividend-paying stocks that increase their dividend between 5 to 10% per year. That just shows that their dividend is increasing at a faster rate than inflation. And as well, this nice 6.4% dividend growth works right in the middle, and it's very nice moving forward. So with a very low payout ratio of 50%, a very strong dividend history of 191 years, they've been increasing their dividend for about 10 years in a row now. I really like this company. I really believe in the dividend moving forward. And another reason I'm picking up this company right now is because of the valuation it's at. So if we jump back here to their Yahoo Finance stats, like I mentioned earlier, is that they currently have a market cap of $45 billion. When we move over to their financial statements, this is their balance sheet. If we look at their cash, these numbers are in millions. So currently in their cash, in their bank account, their cash on hand, they have $56.8 billion of cash. So they have in their account, current assets, cash they have available to them at any moment, they have close to $56.8, $57 billion in cash. Yet, the company is currently trading at a market cap of $45 billion. The company is trading at a total value of the company is trading at a value $11 billion less than the cash they have on hand. So when I buy into this company, I'm buying into the balance sheet. I'm buying into their bank account. They have such a strong bank account of holding $57 billion in their account. They have the most cash on hand out of any of the big 5 Canadian banks. That's very secure to me. That dividend feels very secure. Right now, they pay out $2.8 billion in dividends per year. So of course, with inflation, with growing their dividend every year, that changes the numbers. But if they decided to no longer increase their dividend, they can pay out the current dividend payout for almost 20 years with just the cash on hand they have right now. So of course they have other costs to operate the business, I understand that. But with the cash they have right now in hand in their bank account, they can pay out their dividend for around 20 years. That's how much cash they have. So I feel very safe with this dividend. Of course, we have to look at the liabilities. They have a lot of liabilities. They have $570 billion of deposits, derivative instruments total about $24 billion. There's a total liabilities of $852 billion. Total liabilities and equity of $852 billion. But that's okay because they have so much cash on hand, they can really cover, I've analyzed their balance sheet already, they can really cover any short-term liabilities. They have so much cash on hand, they're in a very great financial position. The second dividend paying stock I'm adding to my portfolio is VRE. So this is Vanguard's Canadian REIT ETF. So of course, the real estate industry has been hit very hard during this dip in the market. There's a lot of uncertainty about if companies are going to go bankrupt, if they're going to survive, because a lot of people are not paying their rents right now because of everything that's going on. So this is a REIT ETF. Because the REIT industry is very uncertain right now, I did not want to go in during this dip and pick individual REITs because I was unsure if they're going to survive or how they're going to perform over the long term. So what I like to do with REITs, because it's very uncertainty right now, I just went for the ETF. I went for the lowest cost ETF out there in Canadian dollars, and I threw my money in there I plan to throw my money in there because it diversifies me across about 20 different REITs, allows me to take that consistent monthly dividend payment or monthly cash flow payment and decide what I want to do with that payment moving forward. So this right here, some very important things I want to point out here is a very huge 7% dividend yield. I do expect this to go down moving forward. I do believe there's going to be a lot of REITs within the ETF that may have to cut their dividend because of the unpaid rent or anything moving forward. But that's all uncertainty. We don't know for sure that's going to happen. Of the largest holdings in the REIT right now, the about top 10 largest holdings, none of them have cut their dividend yet. I looked into that. So they are currently being able to continue paying out that monthly payout. Year to date total return, this ETF is down 26%. That just kind of represents how the REIT industry has performed throughout this year to date, which shows that I'm buying when it's down. You know, the whole idea of buy low, sell high. Because I'm not picking an individual REIT, I feel very safe buying this right now because there's about 20 to 30 very solid REIT holdings within this ETF. Not all of them are going to go bankrupt. The entire real estate industry is not going to collapse. It will to some degree, but all these buildings are not going to go vacant. People need places to work. Retail stores need places to host their stores. They need to pay rent, and people need places to live. So this REIT ETF may have some duds. A couple of these companies may fail to increase their dividend, may cut their dividend, but I overall believe that this entire ETF as a basket of individual REITs is going to perform well over the long term. If we move into from the Vanguard website, the actual stats of the ETF, I want to show you the diversification. Of course, It does have a management fee of 0.39 a MER, but that is actually the lowest cost MER I could find. And of course, with Vanguard, you're getting solid ETFs. This is the highest MER out of my entire portfolio out of the 4 ETFs that I do hold. So it's only a very small part of my portfolio, so I'm not too worried about it having a somewhat higher MER. A MER is management expense ratio. So of course, we look at all the charts. It has been decimated. This is a newer ETF started in 2015. All the potential price growth has been destroyed. If we move here, like I said, the top 10 holdings, most of these have not yet cut their dividend, so we don't know if they are going to cut their dividend moving forward, but it's very diversified, a bunch of different holdings that makes me feel safe throwing my money into this. And this is what I really want to focus on and show you guys here is how the money is sectored, weighting, and how my money is diversified within this ETF. So of course, we look industrial and office REITs make about 30%. Residential REITs make about 20%, retail about 17%, real estate services around 12%, diversified REITs around 10%, and real estate holdings and development around 8% of the fund. So as you see here, my real estate portfolio, my real estate ETF, is diversified into a bunch of different sectors. Of course, I really do like residential REITs. People always need places to live. 20% of my dollars are going there. Retail REITs, in my opinion, are the highest risk REITs right now because of their transition to online industry, but they only make up 17% of my money. So 83% of my money are going to other real estate sectors that I believe will continue to thrive long term. My highest risk one only makes up about 17% of this ETF. And of course, industrials and offices, I do understand people are working from home, obviously right now during our current market conditions. And of course, I understand people are going to be transitioning home moving forward. But industrial and office buildings will always be a thing, in my opinion, over the next 20 to 30 years. I don't think we'll make a complete transition yet where every single employee will be at home. I think there's going to be still a lot of industries that need people together, collaborating in person at a physical location. So I really do believe in my investing horizon that this fund covers all my bases and has a very nice diversification. So we jump back into my portfolio. Those were the two stocks that I plan on buying this week. We have BMO Bank spotting a very massive 6.2% dividend, very sustainable dividend payout ratio at around 50%, with the longest dividend paying streak out of all the Canadian companies out there. And then of course, real estate has been decimated during this dip, and I'm going to be adding Vanguard's REIT ETF, VRE, into my portfolio once again. So I really do appreciate everyone who tunes in. I'm the Gen Z Investor, and on this channel, we talk about personal finance and investing, and I look forward to seeing you in the next video. Thanks.